Hello, everybody, and welcome back. Today, my guest is Jürgen Blumberg from Goldman Sachs Asset Management. Jürgen is the head of ETF Product and Capital Markets. Welcome, Jürgen.
Thank you very much for having me. Welcome. Thank you.
Jürgen, today we want to discuss the China fixed income market and a new ETF product that you launched 2019. So it was one of the first Goldman Sachs ETFs in China bonds. And so obviously this was a very good timing given the current market development. What led you to the decision of launching a China bond ETF?
Yes, so maybe I can start by summarizing why we went into the global ETF business and when we launched our first funds. So in 2015, we entered the global ETF market and meanwhile have 20 products in the United States with 23 billion assets under management. And in Europe, we launched our first UCITS fund in 2019. And by now we have 3 ETFs live and we have a very ambitious launch pipeline for this year. One of the first products was our China bond fund. And our approach to the ETF market is in general, has 2 different angles. So it's to deliver smart products which are built based on Goldman Sachs intellectual property. And the second angle is to give investors access to markets which they might find hard to access otherwise. And the China bond fund was clearly a product for this second category. So why did we launch the Goldman Sachs China Government Bond ETF? It was demand driven and it was predominantly an index inclusion opportunity. So our own fixed income portfolio managers, they came up with the idea. It's a product which is physically replicating. It invests 100% into Chinese government bonds, which is a perfect replication for the JP Morgan Emerging Market Index and the FTSE World Big Index. It has a very low total cost of ownership of 25 basis points. It's easy to implement. It's very transparent. And it was a very good timing indeed, as you said, because the index inclusion stage just started and it gives investors a 3% yield for A-rated bonds and a very positive FX outlook. And that's why it was very good timing when we launched it, and it still is, because the last index, the FTSE World Big, is intending to include Chinese bonds at the end of this year.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. The world is currently looking to China fixed income markets. They have had an incredible year 2020. So what is currently the case for investing in China fixed income and doing so by way of an ETF in 2021?
Yes, so the ETF last year performed very well. So last year, the total return was approximately 8.8%. Even year to date, the index did very well with 1.3%. And especially over the last couple of days, when the global markets became very volatile, Chinese government bonds held up pretty well. And the investment case can be summarized by 5 main arguments. The first one is market size. Second one is liberalization, then increased international investment flows, then the China government bond yields, which are very interesting, and diversification. And give me a little bit of time to really dive into that. So if we look into market size, we will realize that the Chinese government bond market is the second biggest one in the world. The total market, the China government bond market, is the third biggest one, followed by the US and Japan. And if you compare the Chinese market, the total bond market, it has the same size as, for example, Germany, France, and Spain combined. So this just gives an impression of the magnitude. So that's why it's fair to ask, is it too big to ignore? And we think yes. The second argument is liberalization and foreign ownership. And if we compare China, for example, with the US and Japan, so 3 major fixed income markets, we see that the global share of GDP of China is 19%, the US has 16%, and Japan has 4%. But nevertheless, at the moment, China, the bond market, the China government bond market is just 10% owned by foreign investors. And just as a reference, for the US, it's approximately 29%. For Japan, it's 13%. So the target of the local central bank is to increase this figure to roughly 15% or a little bit more, which shows that there will be increased demand in the near future into Chinese government bonds. The next point, which I mentioned at the beginning very briefly, is the index inclusions. And there are 3 global bond indices which have already included Chinese government bonds or will include Chinese government bonds. The first one was the Bloomberg Barclays Global Aggregate Index. It's an index which many portfolios are benchmarked against. And the China bond weight is now 7%. The next one is the JP Morgan Emerging Market Index, where the final weight at the moment has reached 10%. And the last one, which is supposed to start from October this year, is the biggest one. It's the FTSE World Government Bond Index with an estimated final weight of 5 to 6%. So these first 2 indices already attracted approximately 8 billion per month of passive flows. And we estimate that the final index, the FTSE World Big Index, will lead to another 120 to 150 billion of passive flows. So there's again this demand from really index replicators, which will attract further flows into this market. The second last argument is the government bond yields. And for investors, that obviously one of the most interesting arguments, because China is A+ rated. The current yield is approximately 3.2%, which is interestingly more than it used to be a year ago. And if you compare that with a lot of other major markets, including the US, Canada, Italy, UK, Germany, France, you can see that the yield increased year on year. And for most of the other markets, the yield decreased. So for example, if I look at Japan, which is A+ rated as well, it used to be minus 0.02. It's now around 0.05. When we look into Germany, for example, it used to be 0.19. It's now minus 0.52. Or if we look into the massive US market with AA+, it used to be 1.92% and is now 1.07%. So you can see that there is a massive yield pickup of approximately more than 200% if you compare the Chinese government bond market with the US government bond market. And the last reason why we think it's interesting for investors is purely diversification. Chinese government bonds are very lowly correlated with other major asset classes, including global aggregate bonds or even China A shares. And there's almost no correlation with major equity markets like the S&P 500 or with US Treasury bills, which is again proven now, as I said before, global bonds increased volatility over the last couple of weeks, and Chinese bonds, they held up pretty well. And we think these 5 arguments are arguments which investors should and will and do consider.
China in general is regarded still as highly intransparent market. So with a clear advantage for active portfolio management. So why invest in China bonds by way of an ETF?
Yeah, thanks. That's a very good question. And actually our belief at Goldman Sachs is that a strong portfolio consists of active and passive. So it's a very fair question to ask. And we ourselves, we ask that with any new product which we launch, is it better to have an active or a passive mutual fund or active or passive strategy in general? We believe that for this asset class, for Chinese government bonds, that the passive replication is the most efficient way for investors to include those into their portfolios. We think that the Chinese govies market is very transparent. And at the end, the ETF follows an index, which is the FTSE Goldman Sachs China government bond index, it has a very low cost of 24 basis points TR, which is another argument for passive replication. And we think there's very little room for active managers to really make a major difference in this portfolio. If you include other fixed income asset classes, you can clearly say that there's a pick and choose can add positively or negatively to a total performance. But for these govies market, we think passive replication is interesting. And many investors asked us as well, should they buy those bonds directly or should they invest into an ETF? And our argument here is if you want to buy local Chinese government bonds yourself, it's quite complicated. You have different ways of doing that. The most common way now is to go via Bond Connect. But even if you are a professional asset manager and want to invest into these local government bonds, you need to set up a Bond Connect account, which can take between 2 and 6 months. And you need to do this for each fund which you manage. So just because you have one fund set up doesn't mean all of your funds can access Bond Connect. So you need to do this on a vehicle by vehicle basis. And we think here the ETF is pretty straightforward. It's easy to implement, super liquid. So that's why we think it's a perfect tool for investors who replicate one of these indices and who are at the moment under investing in Chinese government bonds.
So let's talk a little bit more about the portfolio and the kind of exposure I do get as an investor. Think especially about currency, but also in terms of onshore, offshore bonds, and also in terms of quality of the bonds.
Yeah.
What do you get there?
Perfect. Absolutely. So the ETF tracks the index. It's a FTSE index. It's a mid-valued index, which means that the bonds are valued at the mid price in the valuation period or in the valuation time. It's govies only, so there's nothing else in there. No policy bank bonds, no corporate bonds. It's 100% government bonds. The effective duration of the fund at the moment is 5.6, which is the effective duration of the index as well, which means the ETF invests into local Chinese government bonds with a duration of sub 1 year up to 30 years. And then the combined portfolio results into this 5.6. The net asset value is calculated in US dollar. The investments are 100% into CNY, into local Chinese currency, which is the ultimate performance which investors participate in. At the moment in the fund, we own 37 different bonds. The index is made of 120 bonds. And the reason why our subset is smaller is there are a lot of smaller and less liquid bonds. So that's why the official expression, it's a sampled ETF, which is very common for the fixed income market. So you would hardly find fixed income ETFs which do full replication. Most of them are sampled to account for these liquidity and size of the issue kind of arguments.
So what kind of investor do you have in mind buying this China Bond ETF?
When we kind of created this ETF, we had in mind really professional investors. Those can be, for example, which proved then to be true as well. So some of our first investors were fund of fund managers who have fund of ETFs or fund of funds in general and needed to include Chinese bonds. It's definitely benchmark investors. So that's why the idea for this fund was created in-house as well. We had our active fund managers and they saw that this inclusion is coming into their benchmarks, no matter it was the Global Ag or the JP Morgan Emerging Market, or in the future, the FTSE VICBI index. And they saw that this inclusion is coming and they needed to find a solution as well. And they then either directly set up Bond Connect themselves to invest into local Chinese bonds, or they could obviously invest into an ETF. So that's why this idea came up. And we still see in the market quite a lot of mutual funds which are underinvested into Chinese bonds, which results then, if you buy this and you are benchmarked, your benchmark is the Global Ag, for example, that you risk to under or outperform. And so that's why it's, I think, very important to have the right level of Chinese bonds in your portfolio. Nevertheless, we think it's interesting, for example, for private banks as well, who have a big part of their portfolio in fixed income and would want to have A+ rated bonds with an attractive yield and with an attractive FX outlook as well. So we think that the local central bank will not weaken the currency, it will further strengthen. So that's our investment outlook. And obviously people who want to have a diversified portfolio, so who want to kind of reduce the volatility of their total portfolio, and that's definitely possible with this low correlated asset class. And I think even from a retail investor perspective, adding 3% yield can be interesting, especially for investors who are medium sensitive to risk, right? So if you have a portfolio which is pretty much long on thematic equity funds, for example, and you want to have a fixed income component to that, then this would be, I think, a perfect match.
The keyword is inflation. So the topic is coming back as a major theme for capital markets. So what considerations did you have in mind when it comes to potential inflation and appreciation risk for the Chinese currency, for the yuan?
Yeah. I think what's interesting about China is that they were first into the crisis and they were first out again. And when we look into the Chinese economy last year, it was one of the only economies globally which really grew approximately 2%. And next to that, then the interbank rate is still quite high in China. It's above 2%. So all of these metrics really show that even if you expect increased inflation, and I read a lot of articles recently, so some make a point for, some make a point against that. We think that from a diversification point of view again, and just to invest your money into something which, at least for the Eurozone or for necessarily for the US dollar, is a different kind of haven for these kind of inflation expectations, then your portfolio should consist of some kind of China bond or CNY investment, because we will see what adds more volatility, the CNY or the China bond itself. But as I said, as a company, our outlook for CNY is very positive. So we expect this year a total return of approximately 4% from the CNY component only, which if you add that to the 3% yield would be a quite interesting package for investor portfolios.
So we've heard a lot about this index inclusion story, and of course you also mentioned this for an argument. How long will it take until China fixed income has their final stake in the overall global fixed income indices, and what does it mean exactly for investors? So is it a kind of free lunch, a non-brainer to invest in China bonds currently?
I think it's very likely that the demand will increase. So it was already high, but we see in the graphs that the slope of the speed of inclusion really increases. And two of those indices, they have reached their final weight already, which was for the Bloomberg Barclays index was December of last year. The JP Morgan EM index was in November of last year. And the FTSE World Big will reach the final weight in September of 2022. And that's, I think, from a pure index inclusion point of view, is the beauty of this inclusion, that it will start at the end of this year and then will last for approximately a year. And will add another 140, 150 billion of passive flows. So we will see continuous demand. And it is what the local central bank wants to achieve as well. They want to increase foreign ownership. That's why they have started to really liberalizing the market in 2015. That's why they introduced Bond Connect. That's why we think there are more steps to come. People talk about ETF Connect as well. There's things like Stock Connect. Potentially at some point there will be hedged instruments or other ways how to liberalize the market. So it's the declared target of the local central bank to really have more ownership. At the moment, the foreign ownership in these Chinese government bonds is around 10%. Target is 50% higher, so at 15, or even above that. So that's why we think local central bank wants it. The indices include those, and so we really think there's really very little evidence that this will not happen. So it will be a demanded asset class.
So this was Jürgen Blumberg from Goldman Sachs Asset Management. Thank you very much, Jürgen, for being with us today and sharing your views.
Thank you much, everybody. Thank you much for the interview.